So today we're going to talk about how the rich are able to avoid taxes legally. And by the way, this has been around for 100 years. This is completely legal, and this is something that anyone can do. So the reason I did this video is to teach you ways that you can keep as much hard-earned money that you make legally. And why is it that the richest people in the world, the richest corporations in the world, pay little or no tax? Stay tuned. So tax, of course, is based on your income. And there's three types of income. There's earned income, portfolio income, and passive income. And I love this example of a McDonald's because you can kind of see how it works. Earned income means a W-2, working a job at McDonald's. Portfolio income would be, let's say you own McDonald's shares and it provided a dividend or some kind of earnings from that. And passive income would be owning a McDonald's franchise where you actually bought that and there were people working in it and it produced an income for you. That would be considered passive. So the IRS treats each of these categories very, very differently. And the earned income is by far taxed at the highest rates. If you want to learn how to reduce your tax legally on your earned, portfolio, or passive income, stay tuned till the end because I'm going to tell you the strategy of exactly how it's done. Let's first take a look at active or earned income. So this kind of income requires you to show up somewhere to get a paycheck or some kind of compensation back. That's active or earned. This is where you trade your time for money. Essentially, money is a claim on your time, and only if you're working do you get it back. And this is the highest tax category. Most people start off in this category, just like me. As a young man, I started off right here working for wages, just like many of you. And I had to learn how to invest in the portfolio category and how to invest in the passive category. And only then did I realize of the massive tax credits and deductions that you get to offset some of this income here. So you just need to be conscious of the category that you're in. It's okay to make a lot of money here, but you need to be investing here and here in order to get the tax breaks, the tax credits, and tax deductions that all the rich and wealthy people are getting. So how does tax work? So what's interesting is here are your tax brackets. Your tax bracket actually depends on your taxable income and of course your filing status, single, married, et cetera, et cetera. But the point here is what you're trying to do here is we're trying to reduce your taxable income. That's where the credits and deductions come from. So you can still make a lot of money, but you want to try to reduce your taxable income and move up and down these brackets legally. So now let's take a look at some of the richest people in the world. Warren Buffett, Bezos, Bloomberg, and Musk. As you can see, their wealth is in the billions. They made billions of dollars. And the total taxes, of course, are in the millions. And while this is a lot of money, as you can see, the true tax rate is super low by all of them. What's the secret to these rich people and why do they have so much wealth and pay such little tax? The secret is that all of this is sitting in earned equity. So the stocks are worth a lot, the companies are worth a lot, but they're not taxed until they're sold. The IRS doesn't get any money until something is sold. Said another way, in the wealth category, these are all the assets that they hold and what they're worth, but until they sell a piece of that, it doesn't get reported as income. Now, there's all kinds of great information on how to get into a lower tax bracket. I would encourage you, these are off the government websites. There's a bunch of ways that you could do this too legally yourself. One thing I found very interesting is that many of the secrets of the rich are not included in this information. I'm going to be talking about that next. So here's the secret. Buy, borrow, die. How rich Americans live off their paper wealth. So in the chart we just looked at, we focused on what people owned, what they bought. So those are people that either bought that through earned income or some other way, but they're in the passive and the portfolio category, and this is what they own. Just like myself, I own $1.5 billion of real estate, but I'm not taxed on that real estate until I sell it. Same thing with Bezos or Buffett. Until they sell their stocks, then they're taxed. So here's a secret to it all. Banks say the wealthy are borrowing more than ever using low interest loans backed by their investments. So what do I mean by that? So let's say you bought a home for $300,000 and that home went up to $500,000 and you do a cash out refinance. That's what this is. This is a loan against something that you already own that has equity in it. And guess what? Loans are not taxed because you have to pay them back. So this is essentially a cash out refinance. Now you can do this with stocks. You can do this with real estate. You can grow your value and you could take income out in the form of a loan, which is of course required to be paid back, and therefore it's not taxed. So this is how the rich get their money out of big assets. And this is what I've been trying to teach you guys on the cash out refinance that we do when I talk about being infinite. Buy something, create more value, put more debt on it, and pull that out tax-free and do it again. Now I'm in the passive income category as opposed to just the earned income category. So we covered the buy. You want to move from earned income to portfolio and passive. And we just covered the borrow. So what's this piece? What's this die thing? What this is this is called a step up in assets to its heirs, or a step up in basis. So this is actually a reality of everyone. So things happen when people pass, period. You either have your estate in order or you don't. You either have a will or you don't. You either have a trust or you don't. But the point is, you do get the step up in assets to the heirs, or the step up in basis. As an example, most of you know that my mom is awesome. She's still alive. She's in her 90s. She's in a assisted care home, but she bought a home years ago that I grew up in for around 20 grand. And that home is worth $700,000 or $800,000. So I want my mom to live a long time, but the fact is she's not going to be. And Mom, if you're watching, I'm sorry for doing this video. But the reality is at some point she's going to pass. And let's say we sell that house for $800,000 and she bought it for 20 and it's now worth 800. Normally, if she were alive and did that, there would be a capital gain. She would pay the difference between her basis, or what she bought it for, and what she sold for in the form of a capital gain. But when people die, you have this step up in basis, and all of that capital gain gets erased, and therefore the $800,000 home, it gets transferred at a new basis of $800,000. So the basis goes from 20 to 800. And this is how the rich buy, borrow, and then die and transfer their wealth to their heirs legally. And you can do this too. But you have to start with moving out of the earned and active income category and move to both the passive and the portfolio side in order to take advantage of the tax credits and deductions that you can legally get by doing this, because people are doing it each and every day, and you can do it too, and it's perfectly legal. So again, thanks for watching.